You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, guys, to today's episode of the Learn Like a CPA podcast. We had some questions come in over the last couple of days, and I wanted to address them on the podcast today. So we're going to be talking about three different topics. The first one is centered around what's known as the Section 121 gain on the sale of a personal residence exclusion. What this allows you to do is, if you own a primary residence and you also use it as your primary residence, you can walk away from the sale of that primary residence tax-free up to certain amounts. So the amounts are $250,000 if you're single, and $500,000 if you're married filing joint. So if you have a spouse, you're filing married filing joint, you can exclude up to $500,000 of the capital gains on the sale of a property. This is a wealth hack because this allows families to gain home ownership, have that property appreciate in value, and when it's time to move, most of them walk away completely tax-free. We do see some people run into issues in high appreciating states like California, but most of the time people are able to walk away from the sale of their personal residence completely tax-free. And the way the math works on that is, if I buy a property for $200,000, and let's say I'm married, and that property appreciates to $700,000, I can sell that property for $700,000 and walk away completely tax-free because I have a $500,000 exclusion on the gain of the sale of the personal residence. You have to own and use it for at least 2 years as your primary residence. What this also allows you to do, what we call the live and flip. A live and flip is where you find a property, you identify, you're going to rehab, force a lot of appreciation to this property, and as long as you live there and use it as your primary residence for 2 years, you're going to be able to walk away without paying any taxes. Whereas if you were to own a rental property and sell it, you have a tax consequence. So Section 121 combined with what we call the live and flip is a great way for people starting off building wealth through real estate and keeping Uncle Sam's hands off their money. The next topic we're going to talk about is house hacking. House hacking is where you find a primary residence, typically a 2 to 4 unit property, where you're going to live in one of the units and you're going to rent out the other unit. Now, you could also do this with a single family home and rent out by the room, but it's most commonly seen with duplexes. And in fact, I myself house hack. I'm actually in my house hack right now. The other tenant's right above me. I house hack because it lowers my monthly cost of living. Instead of paying that full mortgage payment, I'm able to collect rent from the tenant, and in turn, I'm able to lower my cost of living, my out-of-pocket living expenses. A cool thing about house hacking is the different types of ways you can get into it. So the most common is doing what's called an FHA owner-occupied loan. That allows you to put 3.5% down on a multi-unit property as long as you live in it. And the idea you have to understand is, if you wanted to buy that property as an investment property, you would have to put 20 to 25% down. Because you own or occupy the property and you live in the residence, the banks allow you to put 3.5% down. One of the least talked about ideas in the industry is the idea of self-directing your retirement account. Instead of having your traditional money, your Roth money, your 401k money in Wall Street, in stocks and bonds, you can actually take your retirement account and invest it in assets that you know and understand. Self-directing your retirement account allows you to invest in real estate, crypto, other businesses. You can buy land in your IRA. You can buy animals in your IRA. I know some people who buy all sorts of things in their IRA. And in fact, I'm even owning other businesses within my IRA. The financial advisors will not tell you about a self-directed IRA because they're not getting commission. Self-directed IRA allows you to control your destiny, control your future, what your money is being invested in, rather than having it invested in Wall Street, stocks. You're able to make decisions on your own rather than having to rely on the decisions made by CEOs and executives of companies. Another investment vehicle is what's known as a taxable brokerage account. A taxable brokerage account, you put the money in after tax. So your paycheck's going to get taxed before you put the money in. You control the taxable brokerage account. You set it up yourself. It's outside of a retirement plan. You get to decide where you're going to invest that money. You can take your taxable brokerage account and invest it in stocks, mutual funds, bonds, ETFs. The earnings on that account over the years, they're going to grow. You're going to get dividends and interest every single year within that account. You're going to receive a tax statement every year for that account. However, with a taxable brokerage account, there's no penalties for withdrawing early, like there might be for a retirement account. Taxable brokerage accounts also have short-term and long-term capital gain treatments when you go to sell. A short-term capital gain is when you buy an asset and sell it within a year, and a long-term capital gain is when you buy and sell an asset after a year. The biggest difference being the tax rates. Long-term capital gains are taxed at 0, 15, or 20 based on the holding period. Short-term capital gains are taxed at your ordinary tax rate. So in my example, if I'm in a 24% federal tax bracket and I have a short-term capital gain, I'm paying 24% in taxes as opposed to the 15% I would have paid if it was a long-term capital gain. Within this brokerage account, there's awesome strategies you can do if you're somebody who wants to retire early. Because currently under the tax code, a single person can have up to $40,000 of income coming from long-term capital gains and pays 0 in taxes on that money. And if you add in the standard deduction, that number jumps up to $52,000 a year. So if you can withdraw up to $52,000 of long-term capital gains per year, completely tax-free. This is a bridge for early retirement. If you're somebody that says, hey, I want to retire when I'm 40, 45, and you don't want to wait until you're 59, because remember, you have to wait until you're 59 and a half in order to pull money out of a retirement account without having to pay a penalty. A taxable brokerage account is not the same way. A taxable brokerage account, you can pull out the money anytime you want with no penalty. We just want to make sure that when we're withdrawing from the account that we have long-term capital gains. So if you're someone who wants to retire early, you can tell yourself, how much money do I need to have at age 45 in this taxable brokerage account that's going to be my bridge between 45 and 59 and a half. If you have enough saved in the taxable brokerage account when you become 45, you can liquidate that account every single year completely tax-free if you're following up on strategy. Another question stems from, what do I do? Do I do traditional investing or do I invest in Roth? The biggest difference between traditional and Roth is, when do you get the tax break? With traditional investing, you get a tax deduction when you put the money into the account in the year that you put the money in, but your earnings on that account are going to grow tax deferred until you withdraw that money from the account. That's when you'll actually pay the tax. With Roth investing, you do not get a tax deduction up front. However, those earnings grow and compound completely tax-free. And when you do withdraw the money, you're not paying any income tax. The idea there is, hey, I'm at a lower tax bracket the younger that I am, because as I age and go up in my career, I'm going to be in higher tax brackets. So if you're somebody in a low tax bracket, maybe you're just starting off your career, Roth investing is the way to go, because you'll never be in a lower tax bracket than you are right now. And let's be honest, with government spending and inflation, we don't see tax rates going down in the near future. In fact, tax rates are at historic lows currently. They're bound to go up. With traditional investing, the idea is, hey, I want to get a tax deduction for the money now because I'm at a higher tax rate than I think I will be in the future. So if I'm in a 30, 35% tax bracket, I'm going to want to do traditional investing as opposed to Roth investing, because I'm going to get a bigger benefit to investing in that account as opposed to Roth, where I pay the taxes up front and I let the earnings grow tax-free. That's the difference between traditional and Roth. It all depends on what your marginal tax rate is. In my opinion, if your marginal tax rate is 28% or below, you should be investing in Roth assets. If it's higher than 28%, then it's time to start looking at traditional assets. How do you figure out what your marginal tax rate is? You figure out what your federal tax rate is. This is the rate at which you pay taxes on the next dollar. So for me, I'm in a 24% federal tax bracket, and I'm in a 4% state income tax bracket. So I'm right at the cusp of 28%, and I'm still doing Roth investing. If you're somebody in a 32, 35% federal bracket, and then you still have state income tax, Roth investing may not be something you want to do because there's a bigger tax benefit for you to grab your tax deduction now as opposed to letting those earnings grow tax-free. That's the difference between traditional and Roth investing. We'll break it down even further in later episodes. Thanks for tuning in to today's show, guys. If you enjoy the content, make sure to like and follow @LearnLikeACPA and leave some comments below on what you'd like to know in the next episode.